So I had a viewer issue a vague criticism of the video that I put out yesterday, which discussed how to measure the relative merits of gold, silver, and T-bills based upon some very simple and easy to apply metrics. This viewer made a few very interesting statements, and by interesting, I mean incorrect, but also very testable by somebody armed with data and a curious mind. One of the statements that was made, and the one that I will make the focus of this video, was that the only way to make gold shine is to limit its comparison against T-bills. So let's put this statement to the test with a little data so that we can all learn from a major misconception that is floating out there. I'd invite this viewer to make a video of his own with solid data and logic that support his own viewpoint, and to put a link in the comments section of this video for all to see. No single investment approach is right for everyone. So let's get all of the solid data out there and let people choose for themselves what makes sense and what doesn't. St. Augustine said it best when he said, "The truth is like a lion. You don't have to defend it. Let it loose. It will defend itself." Before I get started, let me introduce the central concept I presented in my last video. For anyone who hasn't seen the video yet or would like more details on the method that I've placed a link on this slide that can be followed to see the video. Here I show two graphs. I show trend lines which illustrate how T-bills and silver have performed relative to gold for 5-year holding periods and 10-year holding periods respectively. I also show the results of a very simple model that predicts, based upon the gold to oil ratio, T-bill yield, and the gold to silver ratio, how T-bills and silver would have been predicted to perform at the time. The simple models did a very nice job of predicting actual performance. There was some mismatch, but the correlation was more than 99% statistically significant and did a good job of matching the data to provide the saver with a very valuable tool to use in deciding which asset to use for savings at any point in time. All one needs to know at any point in time is the gold price, the silver price, the oil price, and short-term interest rates, and he or she can determine which of the three asset classes provide the most compelling value. Now that said, let's run a few scenarios just for fun using some real historical data. Let's first look at a baseline at how an investor would have fared if he or she had only bought gold and gold only over the past 45 years. Our investor starts with $100 per month available to save and increases that amount by 5% every year. We'll track the wealth accumulated in terms of ounces of gold as opposed to as dollars because it will help to remove the effects of dollar inflation. So here we see a gradually rising curve. It's not very jagged because we're showing actual ounces of gold owned and not the price. The rate of accumulation changes gradually for our investor as the price of gold changes. When gold increases in price, then the investor's rate of gold accumulation declines somewhat. When the price of gold decreases, then the rate of accumulation of gold increases. At the end of this period of time, our investor has managed to accumulate a little over 500 ounces of gold. Okay, so far so good? Let's proceed. What if our investor had instead decided to accumulate only silver? I put another curve on this plot to show what would have happened over time. At each point in time, I expressed the total amount of wealth in terms of ounces of gold by multiplying the amount of silver owned by the investor by the silver price and dividing it by the gold price. Thus, we'd have a measure of how wealthy the individual would be at any point in time if he or she just sold all of his or her silver and bought gold with the proceeds. What we can see is that the rate of wealth accumulation is a little less steady, owing to the fact that silver's valuation was more volatile than gold's. We can also see that accumulating just silver did not result in as much wealth accumulation as just accumulating gold over the long term. There were a couple of times when this was not true. In 1980 and again in 2011, silver had some pretty spectacular valuation runs, which, if taken advantage of at the time, would have allowed the investor to lock in more wealth. Okay, so let's add another investment class that the saver should be interested in, and that is T-bills. But I must say, before I do this, that I'm not a big proponent of T-bills, especially at the present time, but I do think they have their place in the saver's portfolio if bought intelligently. So here's the T-bills only result. We can see that despite gold and silver being a better place to be in the 1970s, T-bills more than caught up in the 80s and 90s. Between the high valuations of gold and silver at the start of the 80s and the high interest rates offered on T-bills, the person who accumulated T-bills only enjoyed a significant period of time when his or her wealth well exceeded what was enjoyed by the gold-only or silver-only investor. Of course, once the year 2000 rolled around, gold and silver more than caught up. At the very end of this time period, the T-bill only investor ended up with less wealth than either the gold only investor or the silver only investor. And this is a pretty powerful illustration that counters the mainstream argument that gold and silver are not good investments because they don't pay interest or dividends. And I'm not even taking into account the taxes that the T-bill investor would have been paying all along the way on any interest payments made. But I haven't yet refuted my viewers' criticism that gold and silver only look good relative to T-bills, so let's throw stocks into the mix and see what happens. Here we go. The blue curve represents the total amount of wealth commanded by the stock-only investor over time. I've applied the same assumptions, namely that the investor starts by investing $100 a month in the beginning and increases it by 5% per year. I've assumed that the investor chose to invest in a broadly diversified and low-cost index fund representing the S&P 500. I'm assuming that the investor reinvested any dividends that were paid out along the way. I've ignored the effect of taxes on dividends paid as well as upon capital gains distributions. I've also ignored the effect of any costs imposed in terms of fees. So all in all, I'd say that I'm being fairly generous to stocks here. Notice that there was a period in time from the late 90s to the year 2000 when the stock-only investors looked like absolute geniuses. They had managed to accumulate a tremendous amount of wealth compared to the gold-only, silver-only, and T-bill-only investors. But fortune is a cruel master, and what looked like real wealth disappeared fairly quickly over subsequent years as confidence in the infallibility of the stock market waned. Still, to be fair, the stock-only investor did end up with more wealth at the end of this time period considered. He or she could have sold everything at the end and bought about 700 ounces of gold compared to the slightly more than 500 ounces of gold owned by the gold-only investor at the end of this time period. Of course, if I had included the effect of taxes and fees paid along the way, I think we'd find that our gold-only investor would have done better. So how does this prove my point? Well, for one, it demonstrates that gold does favorably compare even against stocks for the long run, except during periods of time when people believe in buying stocks at any price. So the common man should not assume blindly that stocks are the place to be, and only stocks. Clearly, we have seen from the historical record that this was not always the case. In addition, the data shows that from a wealth accumulation standpoint, the results from stocks are much less predictable than just buying gold. This lack of predictability is a big disadvantage for the person who has a finite time horizon and limited ability to make up for big losses. But this isn't the end of the story. Remember how I mentioned at the beginning of this video that there are some very simple valuation tools that can be used to determine whether gold, silver, or T-bills are the best value at any point in time for a simple saver? Well, just for fun, let's see what would have happened if our investor was willing to use these three asset classes, which are often viewed as inferior to stocks, in a savings plan that invested in the one asset that simply offered the most compelling value at the time. Our investor will invest the same amount of money each month as before, but will decide to hold either gold, silver, or T-bills according to what the simple models tell him or her is the best thing to do from the standpoint of the odds. Remember, the investor doesn't know for sure which one will do best, only what the model says should be best. Sometimes the model will be wrong, but more often than not, it will be right. So what our investor is essentially doing is just avoiding saving in something that's overpriced. So let's see what happens. Well, that's interesting. At the end of our time period, our conservative saver would have accumulated about 6.5 times the amount of wealth as our stocks-only investor. Did I make my point? Now, I'm not advocating that people do this. I'm not a big believer in holding 100% of your wealth in any one asset, especially bonds. But modifying your asset allocation based upon some simple valuation tools makes a lot of sense. Most importantly though, it dispels the myth that stocks are always the best place to be for the long run. Clearly, they're not.